currency forwards versus futures. While currency forward contracts are a type of futures contract, they differ from standard future contracts in that they are privately made between two parties involved, customized to the parties' demands for a specific transaction, and are not traded on any exchange. Currency forwards are not exchange traded instruments. They do not require any kind of margin deposit.
Is that okay? It's simple. Just read it. I mean, does it require any explanation? Since currency forwards are not exchange traded, they do not require any margin. Only margin is paid when you are in the stock market. Okay. Okay.
The value of currencies is changing about one another depending on a host of situations, economic growth, political developments, central bank policies, and so on. These fluctuations affect both importers and exporters whose fortunes depend to a considerable extent on the value of the currency. To guard against these fluctuations, they use derivatives like currency options and futures. Of course, it's not just importers and exporters who trade in these. Speculators too are active participants also, hoping to turn in a profit.
So they are both speculators as well as the hedgers. Okay. So let's take an example. I'll just read it. Okay. So there is a company called Information Technology Company. Information Technology Company, Infosoft Limited. Infosoft. This is the company's name. Their clients are mostly in USA, and it's earning in US dollars. Okay. Infosoft Limited expects the value of the INR to increase from 78 to rupees 78 from the existing 82. Okay, so you're earning in dollars. Okay, and then you're repatriating that money to India. So if you earn at the time it was 82, it becomes 78. So that means if you send the money to India, you're going to lose money, isn't it? Just have a look. Expect the value of INR to increase to 78 from the existing 82. So that means the rupee is going to appreciate against the dollar. And you are earning in dollars. And then you are sending money into India. When you earned, the money was 82 rupees. You would have brought that time, you would have got 82. But when you are bringing the money now, it's 78, or you're going to have a loss of what? 4 rupees. This means the losses, since the company has to repatriate its earning in INR from USA to India. Okay. A stronger INR will translate into less money in its kitty. To offset this, Infoset decides to purchase currency options and give it the right, the option that gives the right but not an obligation, to sell the INR 82 strike price. Fine. So they are entering into an options trade and they are selling the dollar in advance at 82, okay, through the stock exchange, because they expect the rupee to go to 78 by the time they bring the money in India. So they are protecting because they have sold someone the dollar. That means they have bought a put option. Okay. If the INR does not strengthen, if the INR does strengthen, to rupees 78. Now, what happens? The rupee strengthens to 78. It will exercise the right to sell the dollar at 82. Fine. Against the US dollar through its options. Hence, it will be able to hedge the increase in the value of INR and its revenue will remain unaffected. Is that okay? Because the rupee has appreciated to 78. They would have brought the money if they had not taken a hedge. They would have lost 4 rupees. But now they have sold the dollars in options trade at 82. So they're going to get 82. The cost is going to the premium only. Let's say if the INR weakens to rupees 85 against the dollar. So here the dollar is appreciating. Okay. If the Infosoft exercises option to sell the strike price of 82, it will suffer a loss of 3, which they can't do. But if suppose they do that, they're going to suffer a loss of 3 rupees. Since it does not make any sense to exercise the contract, it will forego the right to do so. In that case, the only loss the company will incur is the premium it has paid to enter into the contract. Fine. Fine. Agar suppose the dollar goes to 85, so they're happy because when they bring the money, their money is going to grow, so they don't require a hedge. But since they have already taken a hedge and paid a premium, they will not exercise the call option, and they're not going to exercise the put option and let the option expire worthless and going to lose only the premium. What is premium? Well, to enter into any derivatives contract, you have to pay premium to the seller or a writer of the contract. This is generally a fraction of the underlying assets. Premiums are determined by the host of factors like current currency value, the period between the contract start date and its expiry, and so on. As the expiry is far, so the premium will be more. Okay, as I gave an example of the insurance of a car. Now there are two types of. We'll cover 2 more slides, which will cover this entire thing. There are two types of currency options, put option and a call option. A put option gives you the right, but not an obligation to sell the currency at a specified price on a certain date. The above example of Infosoft that we have used is that of a put option. This kind of currency option works best in a scenario where you expect the value of currency like INR to strengthen vis-a-vis another currency. Fine. So that means you're an exporter, you're going to do that, isn't it? The other type of currency option is a call option, which gives you the right to buy the currency at a certain rate. This works when you expect the value of INR to weaken. That means the dollar is going to appreciate, you are an importer. Okay, fine. So options versus futures. So there is a choice here. You can exercise your contract only if you find the price favorable. In currency futures, there is no such choice and you have to exercise the right. So in options, you can walk out of the contract, but in futures, you can't. Either you lose or you gain. Okay, fine. So the options contract, तो यहीं तक ही है अभी. Fine. So I think time is also very near. So let's end it. And we'll start with, a little bit of more of call options, put options. So then we're going to talk about, strike price, option premium, market lot, expiration, in the money, out of the money, which I've already covered through an example. We're going to cover a little bit more. Okay.